So rather than buying individual stocks, you're going to have to pay dealer spreads, which are typically wide. These ETFs are put together by institutions, so they get better pricing, and their expense ratios are very, very low, so our clients keep more of what they earn.
Hi everybody, I'm Conrad Negron, your host for Experts and Authorities. Today we've got a great show. We've got Dana Crosby, principal of SC Capital Advisors, a fee-only wealth management company. Dana, how are you?
Fantastic, Conrad, thank you.
Dana, let's take a little short look back, long look forward. How did you get, you've been doing this for over 20, 25 years?
About 25 years. I started in January of 93. I was a military officer, an Air Force officer for about 8 years. In the late 80s and early 90s, I was a tanker navigator, but while I was in service, I started a master's degree program in finance, concentrating in investments, so that's what got me interested in the industry. And in December of 92, the Air Force offered me a financial incentive to volunteer to get out, and I decided to take it. Started with a major Wall Street firm in the San Francisco Bay Area in January of 93, and transitioned to the RIA, a registered investment and advisor fee-only side of the business in the mid-90s, and have been on that side of the business ever since. In 2011, I had an opportunity to become a principal with a firm down here in Palm Desert. It was then Stein Whittington Danielle, and bought out a retiring partner, and we changed the name of the firm to SC Capital Advisors. And
that's where you are today.
Yep.
Well, let me ask you a couple questions. The retail sector of Wall Street, the big 3-4 names, really changed after the 1987 crash, and fee only, and then you have fee based. What's the difference?
Well, the difference, fee-based are typically, some firms out there can manage money for fee only or charge separate fees, but they also have a broker-dealer affiliation, so they can kind of put on this different hat and sell products, earn spreads on bonds, sell commission-based products, and sell in things like annuities and insurance policies and things like that. Typically, most RIA firms, registered investment advisors, are completely fee only. So we don't sell any products or commissions, and we manage money for fee only, or do a comprehensive financial planning for someone for hourly based fees.
Hourly based.
Yes.
So when you started and transitioning to that next level of wealth management, has Wall Street been behind the curve or ahead of the curve when it comes to, because today they don't even take and execute 100 share orders without copious notes being taken. Is that still?
Yeah, well, just because of their regulatory status, they have a lot more compliance oversight. They've definitely been behind, but one of the biggest things over the last couple of years is that the Department of Labor instituted a fiduciary standard of care with advisors pertaining to ERISA plans, qualified plans and IRAs, and really shook up the industry, but it's really a good thing for investors.
It protects the investors as opposed to the firms.
Exactly.
That's really changed.
Exactly.
Do you think that, they're still out there doing retail, but it's a little bit different. Suitability, is it still the same suitability standards, or is it getting tighter?
It is getting tighter. The fiduciary standard isn't firm yet, but most of the firms, the Wall Street, the brokerage firms, are going down that road pertaining to retirement plans, and it'll, they are, but they still are operating under the suitability standard. But hopefully that will change permanently in the very near future.
What about discretion? Do they allow discretion anymore, or do you have discretion with some of your clients?
We have discretion with pretty much all of our clients. Yeah, so we'll do a comprehensive plan so that we can have a goal-oriented investment strategy. We customize our portfolios. We develop investment policy statements for clients that guide the management of the portfolio. But otherwise, on a day-to-day basis, we work with busy professionals, business owners, and people who don't want to receive a call saying, I want to sell this stock and buy this stock. So, and we hold our clients' accounts at a discount brokerage firm where the commissions are razor thin, and so we have a legitimate reason to buy or sell a stock. And so we're entrusted for the day-to-day management where we have a discretion. That's much rarer on the brokerage side of the business, just because of their compliance oversight.
Because in the old days, people bought something that they shouldn't have bought, it lost, and then the firm gets sued.
Right, and there's there's that concern where the brokers could churn accounts because they, if they're not charging a fee in the account,
so
the
churn and
commissions
burns
are higher.
over.
I hope so. I hope so. Yeah.
What are some of the? You got to watch that market all day. In fact, when we come back, I want to find out a little bit more about how you guys work, and you're doing it a little bit differently than what your standard wealth management people are doing.
Okay.
You're watching Experts and Authorities. I'm your host, Conrad Negron. Stay tuned. Welcome back to Experts and Authorities. I'm your host, Conrad Negron. Here on the ENA Network, today we've got Dana Crosby of SC Capital Advisors. Dana, let's get into the process. How does a client come to you, and what do you do when a guy sits down and says, how can you help me? I want to make a change.
Well, we like to take a comprehensive planning-based approach with our clients for the most part. Typically, we'll send them a fairly detailed profile form, so we want to gather information on pretty much everything from their assets to family members, information on their risk tolerance, both willingness and ability to undertake risk.
Is that a sliding scale today, risk? I mean, you just say 1 to 10, I'm a 7. Does that make me high risk?
Well, there are simplistic ways to assess somebody's risk tolerance, but the objective way is to assess one's ability for risk, which is really the size of their capital relative to their capital spending needs, and then there's of course their willingness, which is more difficult. But really, we kind of ask people about what have their actions been in the past to kind of gauge their willingness for risk and their personality and that type of thing.
Do you think risks associated with, let's just say, from the political side to the international tensions all over the world, oil and gas prices fluctuating the way they are, interest rates still at all-time lows, but the market's really kept a pretty good pace for quite a while, approaching 22,000 and going?
Yeah, ever since February of 2016, we've had very strong markets, and particularly since the election. I think that the market was pricing in potentially higher economic growth, but there's been some obvious typical ups and downs with regard to interest rates in the market. But yeah, otherwise the equity markets have been real strong, and particularly internationally, where we're finally seeing some increased inflation, stronger economic growth in the Eurozone, and those international asset classes have really been leading the market, and part of that is also that the dollar was unexpectedly
high,
weaker though.
Well, and then it weakened.
Yeah, it weakened. Yeah.
Is that good for the world, or is that's not a big of a thing for you guys to worry about?
Not really that big of a thing. We typically concentrate on on the equity side, U.S. Stocks that have the ability to earn above average returns on invested capital. And anytime you're over the long term, when you're investing in U.S. companies, it's been a big tailwind, despite shorter term ups and downs.
Well, we're looking at still 35 year interest rate lows. Mm-hmm. I follow the 10-year as kind of a bellwether of hit about 2.6. It's been trading for the last few years 2.3, 2.5. Is that something that you guys watch?
Yeah, of course. You always you're watching interest rates, and we're in a period of time right now where credit spreads, or the spread between U.S. government bonds and corporate bonds, are at all-time lows, and we're in a period where the U.S. The Federal Reserve is tightening or starting to raise interest rates because things are getting stronger in the U.S. But we kind of think that we're in a period of low interest rates for longer, where it's really going to be a new normal.
A new normal, but I'm not getting a yield that I want. Is that unless I increase my tolerance for risk?
Well, even if you do, like I said, higher yield bonds are trading at record lows, and if we go into a cycle where economic weakening, that's when high yield bonds are going to drop in price, so that we're kind of staying away from that area right now. We think the best strategy is stay conservative, stay short. You have to accept the yields that are there.
Tell me, what is stay short? What's short terms?
I would say an average maturity or duration of around 3 to 4 to 5 at the longest.
So you're talking months.
Years.
Years.
Yeah.
So you're going to get a product. Let's use an ETF, an electronically traded fund.
Exchange traded fund.
Exchange traded funds. How do you manage those? I mean, you may do a 3-year, call date. Do you get out of it early, or do you accept the long?
Well, there's some real newer exchange traded funds out there that are actually on the bond side that actually mature. You can invest in a basket of corporate bonds that will mature in December of 2016 or 17, 18, 19. So you can actually build a ladder, and if interest rates do rise, when that ETF matures and you get your principal, you can roll it out at the higher rate. So it's a good way to protect yourself against rising interest rates.
But these ETFs have really become, even not that long ago, nobody knew about them. Is this a better way to diversify my risk?
Absolutely, we think so. Rather than buying individual stocks, you're going to have to pay dealer spreads, which are typically wide. These ETFs are put together by institutions, so they get better pricing, and their expense ratios are very, very low. So our clients keep more of what they earn.
Why are their expense ratios so low, as opposed to buying individual stocks?
Well, we're talking bonds here, so their expense ratios are low because they're passively put together. They buy they're not actively managed, so thus they keep the expense ratios very, very low.
Oh, okay. And then being fee only, I know what my yield's going to be, as opposed to paying large commissions. You make that deduction.
Exactly.
It's very interesting. Yeah. You're watching Experts and Authorities. I'm your host, Conrad Negron. We'll be right back to find out a little bit more about how your money can be managed correctly. Welcome back to Experts and Authorities. I'm your host, Conrad Negron. On the ENA Network, today we're with Dana Crosby of SC Capital Advisors. Dana, let's talk about it, the institutional thinker. What does that mean?
We call it institutional thinking, and we really try to bring the latest in institutional investment research and asset allocation to our portfolio management process. Traditionally, institutions, like the Harvard Endowment, their concentration was who's going to actively manage your money. Well, there's other types of investment products out there, like exchange traded funds, that bring you the best combination of low cost passive, but yet the portfolios are structured. The securities are purchased and rebalanced based on risk factors that have a history, at least, of showing higher returns and potentially lower risk.
Do some of these, I know that they don't pay dividends like stocks do. Do you look at dividend paying stocks, or is that another way to increase my yield a little bit?
Well, absolutely, and that's really kind of client dependent. If you have somebody who's retired, especially mid or later stage retirement, that needs more income, you're going to be looking at the higher yielding stocks, even on the equity side of their portfolio, which will give you the best combination of growth and income.
Well, what's scary right now for most people? I guess it would depend on your age, your retirement. I'm taking a pension. My Social Security pays me so much. Those are the things that you guys obviously ask clients about.
Yeah, absolutely. Certainly the people who are nearing retirement wonder if they have enough capital to sustain them for what's probably going to be a longer lifespan in retirement, because
people are living longer.
People are definitely living longer. The average age is increasing. So you have those general things that people are scared about, and the people are always scared about market risk. So we are at a period where returns in equities, especially U.S. equities, has been very, very strong, but valuations on a broader scale are kind of stretched at the moment. Well,
there hasn't been a lot of quick volatility, those flash crashes or whatever you might want to call it. Mm-hmm. Is that a major concern for people, or you guys are in areas where it won't be affected as much?
Well, systemic risk can rear its head at any time, and but you're right. We have been in a period here a very low historic volatility, and in some respects it's been eerily quiet, and we at some point in time that's going to end, and
How do you protect yourself? I know some people have, the options markets are always open from, buying and selling puts and calls. Is that a strategy you guys use now or used to use?
Well, purchasing put options for downside protection is an option, but it's difficult to time that sort of thing. And typically, when markets do start getting volatile, the price of protection goes up, and it's usually too late. So it's really what your asset allocation is, and the types of securities you own that's really the most important thing, and just kind of trying to focus on the long term and rebalancing your portfolio. So right now we've been taking money off the U.S. equity side, putting it internationally, and then always making sure that if equities run up and it's above a client's strategic allocation, we take the chips off the table and add it to the bond side of the portfolio.
Do you look at both? Are you a technical guy or a fundamental guy, or a little of both?
Strictly fundamentals. We really discount technical analysis.
Why is that?
Just because the history, the academic history kind of shows that technical analysis adds the least value, although there has been some academic research that shows that momentum stocks, there's a momentum effect in the market that can add value over the long term, but there's no really way to determine when that momentum will end. But there are
You're not
ETFs
staring
now.
at the charts all day long.
Exactly. Yeah. It's really we're focused on the fundamental value of the company and their ability to sustain and generate returns on invested capital.
Well, let's just use as one example. Everybody knows Apple stock, and it joined the Dow Jones 30 industrial stocks, the index. Whatever, it's been a couple years, I think. Mm-hmm. Do you think that was a good thing for a company like Apple to join the index or stay independent? Or it doesn't matter?
It doesn't matter. It's really, the providers of index make those decisions, so I don't think Apple cares one way or another.
They're still selling iPhone 8s for $600 or something like that.
Yeah. iPads, iPhones, and,
But still looking at the valuation, like Apple will stay valued, and we can use this as an example with many of, let's say, S&P 500 stocks. Mm-hmm. These companies are of value, and they're not just going to tank overnight and go to zero.
Well, right, yeah. I mean, that's you get a lot of people who have their tolerance for risk. They think that the market could go to zero, and well, it's theoretically possible during a zombie apocalypse. It's very, very improbable, and markets are going to go up and go down, but the thing is to focus on quality companies that are going to be around for a long, long time.
I think that's one of the biggest advice. One of the biggest advising things that you do give to clients is that, right? Long-term valuation.
Yeah, and that's why we use individual stocks in our portfolio, because I think when markets are tough, you can sit down with a client and say, let's look at what you own, and Johnson & Johnson, this company has been around a long time and will probably be around for even longer.
I love it. We're talking with Dana Crosby, SC Capital Advisors. This is Experts and Authorities on the ENA Network. We'll be right back. Welcome back to Experts and Authorities. I'm your host, Conrad Negron. Today we're talking with Dana Crosby of SC Capital Advisors. Dana, when evaluating clients, tell us about your designations and why we should choose your group over somebody who doesn't have the designations. They don't give these designations away. You're a chartered financial advisor, right?
Yeah, chartered financial analyst, and they also have the certified financial planner designations. There's various types of licenses that you can get in our industry. So for a registered investment advisor, it's called the Series 65, the investment advisor license. It's important to have, but it's fairly easy to get. Brokers have the Series 7 or Series 63 and things like that. We think it's important for when you're looking at an investment advisor, choose somebody who's fee only, choose somebody that has typically a low cost investment approach, but look for credentials. And the chartered financial analyst in our industry is known as one of the most difficult to obtain, and one of the biggest sections in the curriculum, in the self-study curriculum, is the ethics requirement. You're really sworn to high ethical standards, and that's very important. And then the certified financial planner designation is also academically challenging and also one of the most coveted of designations in our industry.
You did a lot of studying, obviously. Is it hard for you kind of to study when you kind of been out of the studying business for a while?
Well, fortunately, I completed those a while ago,
Okay.
so that's behind me. But there are, when you bring that up, it is each to maintain a designation requires continuing education because things evolve in our industry, and most designations, particularly the CFA and the CFP, require ongoing continuing education every year. So just getting those designations was the hard part. Really, the continuing education is the easy part.
What do you see as upcoming, call them regulations? We're in the political side of legislation. With FINRA and the NASD and all the associations that regulate. Are you seeing more regulations that are good or bad?
Well, with the Department of Labor fiduciary standard, it is creating more spending on compliance. All across our industry with our RIA firms and broker-dealer firms. And so it's an adjustment process, but all in all, we believe the fiduciary standard should be across our industry. We've been there ever since the beginning in the mid-90s, and we think that's best for the investing public.
Do you think Dodd-Frank is a good thing, a bad thing, or is it over-regulation?
Yeah, I mean, with the financial crisis of 2008, 2009, I think banks, global securities firms probably needed some more oversight. But I think Dodd-Frank, is probably a bit of an overreach.
Okay.
And I think there's a happy medium. When things happen, there's always a pendulum swinging, and I think the pendulum probably swung a little bit too far.
So it's coming back then?
Yeah, I think it's coming back a little bit.
So do banks have too much power, do you think?
Well,
and the Federal Reserve have too much power? I mean, that's just a hard area.
I'm one that thinks the Federal Reserve did a pretty good job in handling the financial crisis, and some people say they floated way too much capital out there and there's too much liquidity, but so far it hasn't hurt. Interest rates have pretty much stayed down on their own.
So too big to fail is still something to do or something not to do? Or...
Well, obviously, it was a problem. It was a big problem.
Because some people fell and the other people were picked up.
Right, yeah.
So that's not a really big concern to you and your clients right now.
I don't think so. I think that the latest stress test of banks showed that most of them are doing a pretty good job in the increased regulation and their stress testing. So they're passing that pretty well, and banks are, with rising interest rates, they're earning better spreads, and so the banks have actually been doing pretty well. There are some others out there that have had some other unique individual
issues, yeah.
problems. But
do you think why should somebody choose SC Capital Advisors?
Because we are a fee-only fiduciary. We help people, our clients with comprehensive planning and a goal-oriented investment approach.
And you manage the plan continually.
We manage their assets prudently, customized to their own, return objectives and risk objectives and constraints.
So pretty much everybody's a little bit different, no matter what size it is. Everybody's treated individually.
Exactly.
Mm-hmm.
Yeah.
Now, what are you looking for in the coming years as maybe something exciting or maybe something that you may not want to deal with, such as, let's say, political tensions all over the world?
One of the interesting things is that we are, with the exponential growth of technology, the cost of computing power is crashing, and there's some really, the world is changing so rapidly with artificial intelligence, which can be good, but it's also kind of a scary thing. So,
yes.
And technology is having a demonetizing effect all over the world. And most of that is good. Someday they're going to be able to 3D print houses for $5,000 a copy.
Yeah.
So, and especially across the globe in emerging markets, they're making this giant leap into the the technological age. So, so that's really the biotech and technologies where there's some really fascinating things going on.
Dana Crosby, thanks for coming. You've been watching Experts and Authorities. I'm your host, Conrad Negron. Stay tuned. Some more great shows coming up on the ENA Network. Thanks, Dana.